Hello everyone, welcome back. So far in this educational series, we've covered market structure for direction, knowing who is in control of the market, liquidity for targets, to know where price is likely to move next, Fibonacci for pullbacks, how deep a pullback might go within a trend, volume for confirmation, to know how much participation is behind the move, and VWAP as fair value, to know where the market is trading relative to its average price based on real activity. Now it's time to put everything together into something practical. Because the reality is, most traders don't lose because they don't understand the market. They lose because they fight the trend. They try to catch tops and to predict reversals, instead of trading what's actually happening. In this video, I'm going to show you a simple trend following system you can use consistently. Let's get into it. Everything starts with market structure. Before thinking about entries, indicators, or setups, you need to answer one simple question. What is the direction of the market? Because the market is not random, it moves in trends and phases. And your job as a trader is not to predict, is to align with what is already happening. So we have two scenarios, uptrend and downtrend. An uptrend is defined by higher highs and higher lows. This means that buyers are pushing price to new highs, pullbacks are being bought, and demand is stronger than supply. So buyers are in control. Every time price pulls back, it creates an opportunity for the trend to continue. A downtrend is defined by lower highs and lower lows. This means that sellers are pushing price lower, rallies are being sold, and supply is stronger than demand. So sellers are in control. Every bounce is an opportunity for the market to move lower. And this is how we get our rule number 1. Only trade in the direction of structure. If the market is bullish, look for longs. If the market is bearish, look for shorts. Once direction is clear, the next setup is simple. We wait for a pullback. This is where most traders struggle, because instead of waiting, they chase price after it already moved. But the goal is not to buy high or sell low. The goal is to enter at better prices with better risk to reward. Markets don't move in straight lines. They move in cycles: impulse, pullback or consolidation, and continuation. The impulse is a strong move in the direction of the trend. The pullback is a temporary move against the trend. But here's what's really happening during a pullback. Weaker traders take profits, late traders get trapped, and stronger traders prepare to enter. So instead of seeing pullbacks as weakness, you should see them as opportunities within the trend. Breakouts often happen after the move already started. Pullbacks gives you better entries, smaller risk, and higher reward potential. So rule number 2 is trade the pullback, not the breakout. Now let's talk why trading breakouts usually fails. It feels logical. Price breaks a level, so you expect it to keep going. But in reality, by the time a breakout happens, the move has often already started, early buyers or sellers are already in profit, and liquidity above or below the level is about to get taken. What usually happens is price breaks the level, attracts breakout traders, then either pulls back or reverses, trapping late entries. This is because many breakouts are actually liquidity grabs or the final push before a pullback. Instead of chasing a breakout, wait for the breakout to happen, then wait for the pullback, and enter at better prices with confirmation. During a healthy pullback, you want to see price moving against the trend, but not aggressively, momentum slowing down, smaller candles or less conviction, and most importantly, structure remains intact. Now that we have direction, and we're waiting for a pullback, the next step is to refine the entry. This is where confluence comes in. Because we don't want to enter randomly inside a pullback. We want to enter in areas where multiple reasons align for price to react. Instead of guessing, we look for pullbacks into high probability zones where different tools overlap. The best entries usually happen when price pulls back into VWAP, fair value, Fibonacci levels as golden pocket, previous structure, support or resistance, or volume profile such as a high volume node or a point of control. This creates a high probability area where buyers are likely to step in. As we can see in our example here, price moves down. When it starts to pull back, we add a Fib retracement from the high to the last low we add a volume profile on the same move and an anchor VWAP from the high. And this is how we get our area of confluence. We have 382 Fibonacci, VWAP, and value area low of the volume profile. This zone is not an entry, it's an area of interest. Once price reaches it, you still wait for confirmation, reaction, and momentum shift. But even if you have a perfect looking confluence zone, you don't just enter blindly, because a level is only a potential reaction area. So instead of guessing, we wait for the market to prove us right first. Think of confluence as this is where something might happen, while confirmation tells you something is actually happening now. Without confirmation, you're entering based on expectation. With confirmation, you're entering based on evidence. When price reaches your confluence zone, you drop to a lower time frame, like 15 minutes or 5, and look for sign that the move is starting. The first one is a small break of structure. Price stops making lower lows in an uptrend, then breaks a minor high. This shows sellers are losing control and buyers are stepping in. The second one is a strong reaction candle. Impulsive move away from the zone, large candle body, and strong rejection. This indicates real intent, not just random movement. A volume spike, a sudden increase in volume at that level. This suggests strong participation and larger players getting involved. Momentum shift. Candles become stronger in trend direction. Pullback structure starts reversing. This confirms the move is beginning. If you enter too early, price can go deeper into the zone. You get stopped out unnecessarily or you sit in drawdown for no reason. So rule number 4 is let the market confirm your idea. Don't try to predict the exact bottom or top. Let price show you that the level is respected, the reaction is real, and momentum is shifting. Let's see a real example. We start with step 1. We identify the trend. And as we can see, after a swing failure pattern of this last high here, price started to make lower lows and lower highs. Lower low, lower high. Step number 2. We wait for a pullback. And our pullback starts from this low here up to here. Now we measure the impulse using a fib retracement from the high to our low from where the pullback started. We can also add a VWAP, and I'll use an anchor VWAP from the same high, and we get our second confluence right here. Step number 5, we add a volume profile, and I'll use the fixed range volume, again starting from the high to the low that started the pullback, and we get value area low right in the same area as the 382. And this is where things get interesting, because this is how we get our confluence zone. This will be our box for shorts. Because price is in a downtrend, we are looking for pullbacks to continue the trend down. But even if we have our confluence zone, we don't enter immediately. We wait for a confirmation. And for confirmation, we are going on a lower time frame. Here, we wait for a lower time frame market structure break. And I'm using the 30-minute chart because our trade started on the daily chart. So this one is a swing trade. As we can see, the first move down after this high here didn't create a market structure break on this low here. But the second one created a market structure break right here. So in order to get our lower time frame entry, we use again the fib retracement from the high to the low that caused the pullback, and we get an entry at golden pocket right here. So this will be our entry short with stop at the high, and we are looking for lower prices. Now to find our take profit level, we go back on our daily chart. So this is our position here. Now let's find our take profit zone. For take profit, I'll use the fib retracement to find the next support area. And zooming out a little, we can see that the last clear low on our chart is this one here. So I will use this swing low here to pull a fib retracement from there to my last high. And we get an area between the 786 and 886 down here. In order to have an extra confluence for my take profit, I also see that this price here looks like a consolidation, so it has a lot of volume in it. So I want to see where is the most volume in this zone here. So I'll pull a fixed range volume and I get the same area around the 786. So going back, this will be my take profit, the 786 inside this Fib algo. So instead of guessing, we followed a process. Direction, pullback, confluence, confirmation, entry, and take profit. And this is how you trade with the trend. You don't have to worry about catching the absolute top or bottom for entries or for take profits. It's important that you catch most of the move and you have a proper risk management. Now let's see what would have happened if we treated this trade here as a breakout. Because if we look closer, we can see that this price action here looks like a consolidation, or you can see it as a range. And if we use our channel tool like this, you can treat it as a range. As soon as price breaks out of the range and closes above it, most breakout traders will start positioning long up here. But price pushes a bit higher into our resistance zone and from there pulls back. Once price gets back inside the range, most of the breakout traders are trapped and they are starting to close the positions. And this gives our trade momentum. So why our trade worked so well and not the breakout? Because our trade has it all. It has patience, it has structure, timing, confluence, and execution. This is a full system breakdown. So let's put everything together. Our system is simple. Identify direction, wait for pullback, look for confluence, wait for confirmation, and execute. This way we have a clean workflow: direction, pullback, confluence, confirmation, and entry. Most losses don't come from a bad system, they come from not following the system. This system is simple, but it requires patience and discipline. So the key idea is simple: stop fighting the trend. Instead of trying to predict reversals, follow the direction of the market, wait for pullbacks, and enter with confluence and confirmation. When you combine structure, VWAP, Fibonacci, and volume, you create a system that is repeatable and consistent. In the next video, we'll go deeper into range trading and how to trade consolidations like a pro, so you know what to do when the market is not trending. I'll see you in the next lesson. Bye bye!